Hey, what's going on everyone? It's Griffin here, and as always, I hope you're having a great week so far. So the stock market is rebounding quite nicely over the past week or so. We're seeing some positive movements for tech again with the Nasdaq 100 up over 10% since March 8th, and all of this is following a positive employment report from the United States with unemployment rates having dropped by 6% in March, all of which is very positive news for the US economy. Now, we're definitely not out of the woods just yet from a full economic recovery standpoint, and some of the damage may yet still be lying dormant under the rug. However, the stock market is not necessarily one-to-one correlated with how the economy is faring. Nonetheless, the last year has been a really interesting period for investors of all sorts, with 2020 ending a decade-long bull run, which was followed by the quickest stock market crash in history, wiping out over 35% from the S&P 500. And this was then followed by a tremendous rally for tech stocks and companies that investors saw as being positively impacted by a working from home environment. All this to say that over the past year, there have been millions of new retail investors that have entered the markets. And so in today's video, I wanted to quickly share some of my largest wins over this period of time, along with some investments that went south and did not perform up to par with what I was expecting. The reality is that every stock market portfolio is going to have some winning and some losing positions. I'm certainly not immune to this, and so let's dive into some of these positions, starting with the winning stocks. Alright, so truth be told, the last couple of years have been an unbelievable period to make some hefty returns in the stock market. Even if you had, say, exclusively held an S&P 500 ETF from 2019 through to now, having bought the dips and invested consistently, you'd be well ahead, probably by over 40%. That really shows why it's important to have a passive and diversified side to your portfolio with ETFs, even if you consider yourself to be more of an active trader. But the first company that I've done tremendously well with over the past year or so is APHA, ticker symbol APHA on the TSX, which is a cannabis company that will be merging with Tilray to essentially become the largest cannabis manufacturer in the world. With that said though, at the time of first opening up a position in APHA, none of that news was yet on the table and open to the public. I had just done extensive research on all the different Canadian cannabis companies, and APHA really seemed to be the best cannabis company at the time, at least in terms of growth prospects, their financials, as well as operational efficiency. In fact, all of this information I had found on APHA after doing extensive research into the company, and after the stock having lost nearly 75% of its value since mid-2019, I saw this as such a phenomenal opportunity to invest in a quality company at the right time, considering imminent legalization across the United States of cannabis, where the North American cannabis market, including Canada, was expected to grow exponentially through the coming decade. The moral of the story for this stock, though, is that you need to do proper due diligence not only on the stock itself, the company that is, but then also the industry in which this company operates in. For me, I see cannabis as really excelling over the next decade, and so for this reason I was comfortable investing in APHA at the time being at around $3.50 per share. It was a steal. Alright, moving on to the second stock that I've done very well with over the past year or so. This is a stock that I first spoke about that is near the March lows last year, and I know a lot of other viewers had also got in on this position, and so you've most likely done very well with it. The company I'm speaking about is Lightspeed, ticker symbol LSPD on the TSX, and this is a point of sale and e-commerce company, which is quite evidently another industry that I am very bullish on over the coming decade. I speak about e-commerce all the time on the channel. The reason why I first got into Lightspeed though, and have since not sold off any of my shares, is because this company is rapidly growing their users as well as their top line, both organically as well as through acquisitions. And for this reason, I see this stock reaching around the $150 range over the next 2 years. By the way, I've also made multiple videos on the channel speaking about Lightspeed, so if you're interested in potentially investing in this company even at current price points, I would highly recommend that you check out those videos where we dig into the company's business operations as well as their financials. Now, the stock is currently in a slight dip, down around 21% since its 52-week high of $104 that we saw on February 15th. We did also see some resistance though around the $73 per share range going back to around December 2020, and so this could be an opportune moment to open up a first position if you haven't already, to ride through this company's growth over the coming years. In regards to my position in Lightspeed though, well, I first started buying into the stock at around $33 per share, and I averaged up over a couple of different buys, and so now my average price is around $42 per share. With that said, even considering the recent consolidation from the 52-week highs, I am up around 102% on this position as of the time of filming this video, and that is after around a 5.5% increase in today's trading period. With that said, I still don't plan on selling off any of my shares for Lightspeed, as I see this company continuing to grow, and for this reason, the share price appreciating over the next couple of years. And yes, I will admit that for Lightspeed, I was definitely very fortunate to first get into it during the March lows and since right through the tech run of 2020. However, this was still one of my best positions over the past year. Moving on to the third stock, we have WELL Health Technologies, ticker symbol WELL on the TSX. And once again, this is a company that I have spoken about quite a few times on the channel, dating back to around August 2020, when the company had first released their Q2 2020 earnings, and the stock was trading for right around $4.30 at the time, meaning it has since appreciated quite nicely. At this point, I'd be quite surprised if you haven't heard about WELL Health Technologies, but this is a telemedicine stock, and although we did see a rapid run up for multiple company valuations that operate in this industry, including WELL Health, well, I am still of the mindset that with actual reach and expansion of this industry over the coming decade, there is still unbelievable growth ahead, and this is why I've held on to all of my shares of WELL Health. I first bought into WELL Health Technologies at a share price of $3.12, and then further bolstered my position by 50 shares at $7 a piece. And so for this reason, my average price point is $3.70 per share, meaning that considering the roughly 1% return today, my position is up 106% over the past year, or well, the total return that is. However, WELL Health is also one of these companies that I will not be selling any of my shares of, as I see telemedicine growing tremendously over the next 5 years. Again, I've been mentioning this on the channel in practically all my videos, so yeah, WELL Health, I will not be selling off any of my shares. Next up is a stock that many of you may not even be aware of the fact that I hold it in my portfolio, and even though the overall dollar return is quite minimal, the actual return from a percentage standpoint is great, so I couldn't leave it out of today's video. The stock I'm speaking about is Uber, ticker symbol Uber on the NYSE, and everyone's well aware of what this company does. They're the main ride-sharing platform, and they have since branched off into other facets such as food delivery with Uber Eats. At the beginning of 2020 though, with everything shutting down, the outlook for a company like Uber was pretty much at all-time lows because no one really needed to move around cities, and that is their main business model. However, they have branched off into other facets like Uber Eats, which let's look at some data right now. After considering the fact that this had all led up to the stock plummeting almost 50% in March 2020, which I saw as the opportunity to scoop up a couple of shares. And now, as unemployment figures have risen again and the need for ride sharing has increased, the outlook for a company like Uber has been mainly restored, and this past year was also a massive opportunity for them to scale out Uber Eats because the need for this type of service skyrocketed. Just take a look at these figures where the total revenues for Uber Eats grew by 152% from 2019 to 2020, and users grew by a whopping 214%. So anyways, I spoke about this stock on the channel only one time last year, and it was trading at around $22 per share, and I personally bought only 12 shares, unfortunately, at an average cost of $21.78. Nonetheless, even though this doesn't represent anything major, it is still a return of 168% on my investment, which is pretty phenomenal. And interestingly, this is just under the largest return possible that an investor, a retail investor that is, could have received on an Uber investment, since this was basically at all-time lows for this stock. I haven't bolstered my position though, and I don't plan on doing so, just because I see a larger opportunity in other industries and with other companies that I would rather invest my capital in. Alright, and finally for the stock wins, yes, I have had many other positions increase in the 30 to 40% range. However, if I featured them all in this video, it would be way too long. So I'm just going to cut it here at the last one, one being Tesla. And let's be honest, pretty much everyone who has held Tesla over the past couple of years has made a killing, excluding this short little period of time where Tesla has consolidated down a bit. However, also considering the 5-to-1 stock split that we experienced for Tesla in 2020, pretty much everyone has made a killing on this stock. I mean, I remember people even saying that they had sold off their shares of Tesla at around $700-800 per share pre 5-to-1 split, and they had already made multiple hundreds of percent return on that investment. So even after the split, Tesla stock managed to somehow appreciate back up to a 52-week high of the pre-split stock price of $900 per share, which is just nuts if you think of it. All right, so now that we've had the chance to cover some of my best positions over the past year, well, let's speak about some stocks that did poorly, because yeah, there were some. And by the way, if you're enjoying this video up to now, please make sure to drop a like. It really helps the channel out. And here's the thing, we have been in a very nice bull run since the beginning of 2020 in March up until, well, pretty much now, other than tech having seen a slight dip over the course of last month. However, the broader market has been pretty much untouched. So for this reason, if you haven't sold off any of your positions, chances are your overall portfolio is still very much in the green. This is something that I actually speak about quite a bit on my channel in regards to a longer term investing strategy, right? I'm not a day trader. So on positions that I open up a position in, well, I've done proper due diligence. And so for this reason, I'm typically more comfortable buying the dips and dollar cost averaging my way into these companies over the course of time that I am holding them based on my thesis around what I think this company is going to do over the coming years. And of course, I will have positions that do not perform nearly as well as I expect them to. This is pretty much just the name of the game. I'm not going to sit here and say that none of my positions have lost value. However, by doing proper due diligence and really holding these stocks throughout dips and valleys, well, this is a period, well, I'm therefore minimizing my risks of having positions go severely into the red and having to cut my losses. With that said, there are a few stocks that I recently opened up positions in that, considering the recent dip, are still very much in the red. However, I plan on holding them for multiple years in the future based on my thesis around the companies and the industries that they operate in. So the recent price point is pretty much irrelevant to me. All right, so the first stock that I purchased over the course of the past year that performed quite poorly was actually one of the only positions I have ever sold off at a loss and materialized a loss, meaning I actually sold it off at a price point that was lower than what I purchased it for. And you could attribute this to luck and good timing with my investments, which definitely did have a contributing factor in the overall success of my portfolio up to now. But really, every single position that I first open up, I have done extensive due diligence on, and I have a multi-year, typically, time horizon ahead of me to materialize some gains on these individual stocks or even exchange traded funds that I'm adding to my portfolio. So this is very much minimizing the losses of my portfolio because I'm not looking to day trade or even short-term swing trade. I'm investing in industries that I believe will do well over time. So back to those positions that I just spoke about that are currently in the red after having just opened up a position in them. Well, yeah, right now they are in the red. However, it's relevant to me because I've done due diligence on these industries, on the companies, and I do believe that they will recover nicely and turn back into the black for these positions and do well for my portfolio. But back to this first stock in question, it is Real Matters, ticker symbol REAL on the TSX. I first bought into this stock at an average price of roughly $29 per share, and then from that point on, it just tanked further and further. I did end up cutting my losses though on this stock at an average price of around $19.70, materializing a loss of roughly 32% on that position. And by the way, I did mention in a video at the time that I did sell off my position in that stock, and in retrospect, I'm happy I did because the stock continued tumbling down by around another 20% to the price point that it's sitting at right now. Real Matters was by far one of my worst picks, and considering the company's growth and financials, well, I really thought that this company and the stock that is in my portfolio would perform quite a bit better. However, after conducting further research after opening out my position, I just concluded that, my convictions changed on where I believe the stock was going to trend over the next year or so, and so for that reason, I cut my losses and basically sold at a 30% loss on this stock. But investing is about continued research on new positions, but also the ones that you hold in your portfolio. So when you have a position that isn't performing up to par with what you had expected, you need to reconsider it and look at, well, do I want to either lower my cost basis by dollar cost averaging, buying the dip and buying more, or do you want to just simply hold the stock because you're kind of on the fence as to whether or not you want to pour more capital into it or just sell it at a loss, or even just cut your losses like I did on Real Matters. I personally just chose to cut my losses on Real Matters and invest that capital elsewhere, which in retrospect, I am happy I did because I was able to invest it in other higher growth stocks where I made a substantial return. The next position that's done quite poorly since first buying in is HCLN, which is actually a renewable energy ETF. And since first buying in only around 1 month ago, my position remains down roughly 15 to 20% depending on how the ETF fluctuates in value. With that said, I haven't sold off any shares, and so this isn't a material loss, rather it's only an unrealized paper loss for the time being. And based on where we're heading as a society in regards to a higher consumption of renewable energy, well, I have strong faith in HCLN and conviction in the fact that this position will go back into the green for the longer term growth of my portfolio. This is a concept that I think a lot of newer retail investors need to understand and ask themselves. If you open up a position in a given stock or fund, hopefully it is for a specific reason after having conducted research. Now, if the market value drops down by say 10, 15, 20% in, let's say, a 1 month's time frame, well, other than the fact that the share price has gone down in value, what really has changed in that position in regards to your mindset towards it? I'm not talking here about day trading or just gambling speculative stocks. I'm talking about an actual company that you believe in based on certain financials and company's growth. What really has changed in your mindset towards it? Typically, this is an opportunity for me in my positions to lower my cost basis on stocks that have receded down in value. So yeah, HCLN though has pretty much just receded down in value since I first bought in, but again, I have strong conviction in the fact that this stock will recover quite nicely in my portfolio as over the coming years, we as a society will be putting a lot more focus and emphasis towards renewable energy. So that pretty much covers what I wanted to speak about in today's video, and if there's anything I want you to take out of it, it is the following elements. First of all, it's really important that you conduct proper due diligence on any new position that you open up in your portfolio, but then also on each one of the positions that you're holding. This is something that as an investor is really important that you do as an exercise every couple of months minimum in order to stay up to date with what each one of these companies is up to and what their financials are looking like. The second element is that you need to, at the very minimum, diversify your holdings into a handful of companies so that you're not overly exposed to only one or two given stocks. One way that you can do this quite easily as a retail investor is just by holding a handful of core exchange trade funds in your portfolio. As we spoke about earlier on in this video, even if you had only purchased an S&P 500 ETF, for example, continued buying the dips every single month and consistently investing, well, you would most likely be well above 40% in returns over the past 2 years on just an exchange trade fund passive holding. And the third and last element is that it is completely normal for every portfolio to have some really good positions that perform exceedingly well, as well as a handful of positions that might not perform up to par with what you were expecting for them. But it's how you deal with these wins and, more importantly, these losses that really determines your longer term success in your portfolio. Before panic selling a position, make sure to conduct some up-to-date research on why you're selling it in the first place and also why it is down in the broader market or even for a specific position. If your convictions change, then yeah, it might be time to cut your losses and reinvest that capital elsewhere. But if it's just a temporary correction, then chances are that holding or maybe even adding to the position could be the right option. With that said, I was actually thinking of making a video speaking about when I consider cutting my losses on a stock and selling it. So if that would be of interest to you, then make sure to comment down below and I'll try to get to that over the coming weeks. So that pretty much wraps up today's video. I really hope you enjoyed it. If you did, make sure to smash the like button, subscribe to the channel, and hit the bell button to be notified of new and upcoming content. Also, if you're a newer investor, then make sure to check out all the resources that I use and recommend down below. So thanks a lot for watching today's video, and on that note, I will see you in the next one.